Do you know what swap is and how it affects your trades? If you invest in Forex, commodities, or indices and you don't understand this concept, you might be losing money even without realizing it. Hi, I'm Chad with Zero Markets, and today we're going to talk about a technical topic that directly influences your net profit in the market: swap. This video is for anyone who trades in the short or medium term and they want to understand in a simple way what swap is, how it works, when it can be positive, and when it becomes an invisible villain for your results. Go ahead, hit the like button, subscribe to the Zero Markets channel, and turn on notifications because the content here is straight to the point and it's always presented with responsibility. Okay, what exactly is swap? Swap is the daily interest rate adjustment between the currencies in a pair or between asset contracts. Every time you hold an open position overnight, the broker needs to calculate the interest rate difference between the countries involved in that trade. A simple example: imagine you're long on the US dollar to Japanese yen. The US dollar has a different interest rate than the Japanese yen. If the US interest rate is higher, you can earn a positive swap. If it's lower, you pay a negative swap. In practical terms, it's like you're borrowing one currency and lending another one. And for that, there's a cost or a credit. Why? Because it goes directly into your account every single day. Even if you don't trade the next day, if your position is still open at midnight or the broker's closing time, the swap will be applied. And here's the key point: in long-term trades, this value can eat up a large portion of your profit. Practical example: imagine you're long on the Australian dollar to the US dollar, gold, and you hold that position for 12 days. Each day, a small fraction is debited or credited. By the end, this value can exceed $10, $20, or even $50 depending on the position size. Yes, there is such a thing as positive swap when you get paid for holding a position. This happens when the interest rate of the currency you bought is higher than the one that you sold, or in contracts where your position generates an interest credit. But be careful. Trading solely to earn a positive swap can be risky because the markets might move against your position and the loss could be greater than the swap gain. In other words, swap can be an ally, but it should never be the main reason for a trade. Practically speaking, you need to check with your broker or your trading platform. At Zero Markets, for example, this value is available within the asset specifications. You can see how much it costs or how much it earns to hold that position before you even open the trade. This point is crucial for anyone who builds long-term positions in pairs like EUR to TRY or USD to ZAR, or even international indices. Here's an important detail: Wednesday is the day when the market accounts for the triple swap. This happens because the market needs to include the weekend in the calculation. So if you hold a trade open on a Wednesday night, you pay or receive 3 times the normal swap value. Now, many people forget this, and that's when they get a nasty surprise the next day. Let's recap. Swap is a daily interest adjustment between the currencies or assets of an open position. It can be positive, it can be negative. It may seem small, but it directly affects your bottom line. Want to trade with more consistency? Include swap in your analysis. And most importantly, never open a position without knowing the cost of holding it open for days. If this content helped you clearly understand what swap is and how it impacts your trades, please like the video and subscribe to the Zero Markets channel. Every week, we have new videos about strategies, concepts, and the mindset for those who take the market seriously. And tell me in the comments, have you ever been surprised by a swap on a trade? Let's share experiences.